Welcome to the Coin Bureau Weekly News Roundup. Here are the top stories in crypto this week. Crypto market rally. Coins and tokens explode after institutional interest increases, with BTC breaking 31K for the first time in months. Will the rally continue, or will we see a correction? Interesting Ethereum updates. Devs consider raising the maximum stake for validators, the ETH staked through Coinbase declines, and questions arise about Ethereum's origins. How could this affect ETH? More Stablecoin FUD. TrueUSD claims it has no exposure to Prime Trust after minting 1 billion TUSD, while traders bet against the stablecoin. Everything you need to know. Bitcoin ETF Frenzy. Asset managers line up behind BlackRock with their spot Bitcoin ETF applications as the SEC approves a leveraged futures Bitcoin ETF. What does this mean for BTC? And a closer look at last week's top-performing cryptos and where they could be headed next. All this and more in just a moment. Good morning, afternoon, or evening. Thank you for tuning in. My name is Guy. None of what follows is financial advice, and here is the news. Last week, the crypto market experienced its biggest rally in months. Now, the rally is believed to have been due to an increase in institutional interest and investment because of BlackRock filing for a spot Bitcoin ETF. This was not the only factor involved, however. Another contributing factor was a series of short squeezes which totaled over $150 million for BTC alone. To refresh your memory, a short squeeze is when traders who bet against the market are forced to buy back their positions. It's been a while since we've had a proper short squeeze. Besides that, it was ultimately an absence of any bearish macro or crypto factors that allowed the markets to run. This is something that we predicted in last week's newsletter, so be sure to subscribe to that if you want to get our take on what comes next. The link will be in the description. Now, fortunately or unfortunately, the recent rally has been more favourable to some cryptos than others. The biggest beneficiary has, of course, been BTC, and this can be clearly seen in the Bitcoin dominance chart, which measures how much of crypto's total market cap is just BTC. A rise in Bitcoin dominance is common in the months leading up to the Bitcoin halving, which will take place early next year. The good news is that an increase in Bitcoin dominance is considered by many to mark the early beginnings of a new crypto bull market. The bad news is that these early beginnings can still be brutal for most altcoins, and some still haven't reached their lows for this cycle. The silver lining is that this allows you to accumulate the coins and tokens you believe have potential for when the bull market comes back in full force. If you've been keeping up with our weekly crypto reviews, you'll know that we've been using the ETH BTC chart as a proxy for assessing how well altcoins are doing overall. You'll also know that they haven't been doing so well. ETH has been crashing against BTC to the point that it's in the news. If you pull up the ETH BTC chart on the monthly and slap on the Bollinger Bands indicator, you'll notice two things. First, ETH is on the cusp of a very bearish monthly close against BTC. Second, there is a very big squeeze, a long period with no volatility, which often means that some kind of volatility is coming. If this volatility spike pushes ETH to the downside, then it could mean many more months of bear market blues for most alts, possibly including ETH. Now, to clarify, this doesn't necessarily mean that alts won't rise in fiat terms, just that they'll be getting wrecked in BTC terms. Regardless, it's something to keep an eye on. BTC's monthly chart also seems to foreshadow more pain in the medium term. The recent rally up to 31.5k touched the Bollinger Band moving average, which has been a key level of support and resistance. If BTC gets rejected, it means more pain. If BTC can get above and stay above, it means more gains. But back to ETH. Now, Ethereum has had some interesting updates lately. For starters, developers are considering raising the maximum ETH stake to 2,048 ETH per validator. To clarify, the minimum stake will still be 32 ETH. It's the maximum stake that devs want to increase. The rationale behind the proposed change is basically that Ethereum will have too many validators if it keeps the 32 ETH limit. To put things into perspective, Ethereum already has over 700,000 validators, and there are still tens of thousands waiting to join the network. The proposed change would also make it possible for Ethereum validators to compound staking rewards. Right now, validators must send any ETH staking rewards they have to a separate wallet. Increasing the maximum from 32 ETH to 2,048 makes it possible to accumulate stake in the same wallet. This dual proposal has been met with mixed reviews from the crypto community. On the one hand, it would make Ethereum significantly more centralized. On the other hand, it would make ETH staking more convenient, particularly for institutions, which is possibly the real motivation here. Case in point, the dev who proposed the changes specified that it would help cryptocurrency exchanges, which currently stake ETH across thousands of validators. This requires a lot of oversight to ensure all validators are operating correctly and results in increased hardware costs. Now, this might not be a problem for crypto exchanges in the United States if the SEC wins its case against Coinbase. If you watched our video summarizing the suit, you'll know that the SEC believes that exchanges providing crypto staking constitute a securities offering, which makes no sense. Topic for another time. Now, it appears that the SEC's scrutiny of staking via crypto exchanges has resulted in mass ETH unstaking from US exchanges. In the case of Coinbase, it now accounts for less than 10% of the ETH staked, an almost 30% decline from the near 14% market share it had in April of this year. Meanwhile, the amount of ETH being staked via liquid staking DeFi protocols has spiked, especially on Lido Finance. This has likewise caused concerns about staking centralization and also regulatory scrutiny. Note that the SEC is reportedly planning on cracking down on DeFi protocols. In any case, the one crypto entity that the SEC is not going to be cracking down on anytime soon is Prometheum, which somehow received regulatory approval from the SEC. For context, Prometheum is the first SEC-registered broker-dealer for crypto, a status that crypto exchanges have been trying to get for a long time. Nobody knew what Prometheum was until its co-CEO testified to Congress earlier this month. Ever since then, crypto sleuths have been looking for connections, and it turns out that Prometheum is connected to Ethereum. Both were backed by Wangxiang Blockchain, a Chinese non-profit. What's concerning is that Wangxiang Blockchain is believed to have connections to the Chinese Communist Party, or CCP. The former CEO of Wangxiang famously invested in ETH in 2015 after meeting Ethereum creator Vitalik Buterin. The connection has been a source of FUD for Ethereum ever since. What's even more concerning is that this connection seems to be more than just FUD. Vitalik was reportedly listed as the chief scientist of Wangxiang Blockchain, and the Wangxiang Blockchain Facebook page claims Vitalik was a co-founder of the organization in 2016. Then again, this could be a PR fabrication. After all, crypto companies and projects are notorious for faking partnerships and affiliations, not naming any names, of course. Anyway, speaking of FUD, stablecoin issuers have seen no shortage of that either. 2 weeks ago, it was Tether's USDT, and last week it was TrueUSD's TUSD. This time, it was because of speculation that TrueUSD had lost the ability to mint and redeem TUSD due to issues with Prime Trust, a US crypto custodian. On Twitter, TrueUSD claimed that it has no exposure to Prime Trust and that it has multiple banking partners that offer minting and redeeming services for stablecoins. This is a bit hard to believe, given that US regulators have been cracking down on banks providing these kinds of services. On that note, if you watched our video about how stablecoin market caps affect crypto prices, you'll know that TrueUSD had been keeping a significant chunk of its reserves with Signature Bank before the latter went under. These reserves were subsequently transferred to a bank in the Bahamas that Tether also uses. You'll also know that we speculated about the possibility that Binance was working to replace BUSD, which can no longer be minted, only redeemed, with TUSD. This is in part because Binance owns almost all the TUSD in circulation, and in part because Binance has been heavily promoting TUSD's use. This promotion has come in the form of zero fees for TUSD trading pairs, which the exchange will expand starting from the 30th of June, this Friday. The practical effect of this will be that the demand for TUSD will increase, causing its market cap to rise even faster than it has in recent months. However, this assumes that traders will take the bait and buy TUSD for the zero fees. Some are still skeptical of whether TUSD is legit, and others are expressing this skepticism by shorting TUSD, betting that it will break its peg. So far, TUSD has managed to keep those skeptical traders in suspense. Even so, it does beg the question of what would happen if TUSD broke the buck. The short answer is probably not much, because the stablecoin is still small compared to its competitors. Traders and exchanges alike would simply switch to using USDT or USDC with minimal disruption. That said, an issue with TUSD could lead to speculation that other offshore stablecoins, such as USDT, are at risk. Recall that TrueUSD and Tether are using the same bank in the Bahamas to store a significant chunk of their respective reserves. Also recall that regulators seem to be targeting such banks. The intense regulatory scrutiny around stablecoins logically means that no stablecoin is truly safe, but it's generally believed that USDC is the safest. This is purely because USDC Issuer Circle is backed by BlackRock, the world's largest asset manager. BlackRock also manages USDC's reserves. Some would say that this is the exact reason why you should stay away from USDC, but let's not go there. Now, besides backing stablecoin issuers and partnering with crypto exchanges, Coinbase, BlackRock has also been investing heavily in Bitcoin miners via its ETF offerings. If you watched our video about Bitcoin and ESG, you'll know that BlackRock & Co. are interested in influencing BTC as much as possible. Thankfully, Bitcoin is proof of work, meaning that BlackRock's spot Bitcoin ETF will overwhelmingly be a benefit to BTC. Its blockchain won't be affected by the amount of BTC the ETF holds. An infographic we found suggests that BlackRock's spot Bitcoin ETF application could be approved as soon as the 12th of August. This would explain why other ETF issuers are rushing to throw their hats into the ring. They are hyper-aware of the fact that the SEC has approved all but one of BlackRock's 576 previous ETF applications. When or if the SEC gives way to BlackRock, the door will be open to other entrants. Now, to recap, a spot Bitcoin ETF will invest directly in actual BTC. This is in stark contrast to the futures Bitcoin ETFs currently listed in the United States. These ETFs invest in paper contracts on regulated US futures exchanges. In other words, they invest in Bitcoin synthetically through instruments tied to Bitcoin's future price, not BTC itself. This is why the leveraged Bitcoin futures ETF the SEC recently approved will have no direct impact on BTC's price. All it will do is send a signal to institutional investors that the SEC is open to approving crypto-related investment instruments, which is surprising given the regulator's recent crypto scrutiny. It's also possible that the listing of this leveraged Bitcoin futures ETF could mark the local top for BTC's price. This is because the listing of Bitcoin futures on the CME occurred around the BTC top in 2017, and the listing of the first futures Bitcoin ETF occurred around the BTC top in 2021. Now, this correlation could be a coincidence, but there's some science to it. BTC needs a bullish catalyst for a blow-off top, and it just so happens that the listing of these investment instruments were such catalysts. This makes the SEC's decision to approve the leveraged Bitcoin futures ETF that much odder. In case you haven't noticed, we're not exactly in a crypto bull market yet, so why would the SEC go out of its way to approve another Bitcoin ETF now? Again, this would be the SEC's way of sending a signal to institutional investors that it's open to approving BlackRock's spot Bitcoin ETF application. If it's not some secret signal, however, then its listing could very well mark a local top for BTC's price. This would coincide with what I mentioned in BTC's monthly chart earlier in the video. It could also foreshadow BlackRock's spot Bitcoin ETF being approved when BTC prices are low, not high. Now this would catch retail investors off guard, and maybe that's the idea. Institutions know that we've been watching crypto's historical cycles closely, and that we know ETF application approvals occur around BTC cycle tops. Approving an ETF when BTC prices are low would fly in the face of everything we know. It would also be characteristic of the so-called Wyckoff method used by institutional investors to shake out the retail traders. You can learn more about that using the link in the description. So, turning to the charts, we can see that BTC bounced off that Bollinger Band moving average on the weekly chart, something that we had discussed last week. It's not entirely clear where BTC heads from here. On the daily chart, BTC is still very overbought, but its price appears to be painting a bull flag. ETH's price action makes much more sense. ETH has been struggling to get above a significant zone of resistance in the low 1900s. So far, it's managed to hold up quite well. If it can break through this zone, the next stop could be 2K. If it fails to break this zone, then it could fall to 1800. If you want more in-depth technical analysis, then I encourage you to subscribe to Coin Bureau Trading. Dan, a professional trader, will give you the ins and outs of how to navigate this current market. Link is in the top right. Anyways, last week's top performing cryptos were Bitcoin Cash, Pepe, Aave, Compound, and Bitcoin SV. So, starting with Bitcoin Cash, BCH appears to have pumped in response to the news that it was one of the few cryptos that the new institutional crypto exchange EDX Markets supports. For reference, EDX was recently launched by Fidelity and other massive Wall Street players. Not surprisingly, BCH is extremely overbought. Lo and behold, its price touched the Bollinger Band moving average on the monthly chart. I find it hard to see how it could go higher from here, but hey, stranger things have happened in crypto. This ties into Pepe, which pumped for absolutely no reason whatsoever. I mean, seriously, the Pepe Twitter account has just been posting memes, and not even that frequently. This amount of speculative investment could be seen as a contrarian indicator. There are still too many bulls around. Now, I hope you'll forgive me for not analysing Pepe's price action. Meme coins are completely unpredictable, at least in my experience. It's a similar story for Aave. It's not evident why the Aave token pumped so much. There is some on-chain evidence suggesting that whales have been accumulating, but the question is why? Well, one answer is that Aave is decentralized, so it's safe from regulation, in theory. The other could be its upcoming Go stablecoin. Similarly to BCH, Aave's price is battling with that Bollinger Band moving average on the weekly. The difference is that the Bollinger Bands on Aave's monthly chart are squeezing. Remember, this means we could be about to see some serious volatility. Let's hope that volatility is to the upside. Funnily enough, Compound's Comp token is in a similar position. It's also not evident why Comp rallied, but it could be a consequence of the Aave rally. DeFi tokens tend to move in tandem, especially those that are similar. Aave and Compound are both lending protocols, so that could be the reason. It would certainly explain why Comp's recent price action looks identical to Aave's. Comp is also battling with that Bollinger Band moving average on the weekly, which is also squeezing. This further underscores the possibility that Comp will follow Aave to the upside or the downside. And finally, we have Bitcoin SV, whose BSV coin appears to have pumped in response to the recent Bitcoin SV conference in London. It boggles my mind as to how some of these Bitcoin forks are still alive, but hey, stranger things have happened in crypto. This comment is relevant to BSV's price chart, which arguably speaks for itself. Note that you can keep track of which altcoins are pumping and why by joining the Coin Bureau Telegram channel. The link will be in the description. And that's all for today's Coin Bureau weekly crypto review. So if you enjoyed it, you know what to do. Hit that like button, subscribe button, and bell icon too. If you're looking to help those gains grow, then the Coin Bureau deals page is where you should go. There are tens of thousands of dollars in airdrop bonuses, trading discounts, and products to help you trade like a pro. You can find the link to that resource and many others in the description below. Thank you so much for watching, and I'll see you all in next week's episode.